Good. Welcome, everyone. My name is Rainer Kölgen, and I'm a senior advisor with PPNC Auditores Independentes in Sao Paulo, Brazil. On behalf of the Nexia TI Business Group, I would like to welcome all of you to another of our webinars. Today, we will be taking a closer look at emerging markets and the impact from COVID-19, and also an outlook for the next year or two in certain regions and emerging markets. Presentations will be held, and I start with my colleague Sujata Jaffer from Nexia SG Tanzania. She's a managing partner of Nexia SG in Tanzania. And she will be speaking about the East African region, Tanzania, Kenya, and neighboring countries. Sujata is 13 years with Nexia SG, and she represents Nexia in Tanzania and Kenya. Also with us today are Yihong Chen, my colleague from Nexia TS in Singapore. He will be covering in his presentation China and the South Asian region, talk a little bit about the impact of COVID in those countries. And then we also have today with a presentation here, Manik Abot. He is a director with Next Time in India, and he will be covering India and the region in his presentation. At the end of our presentations, we will have a panel discussion with like 4 or 5 questions at the end. I will moderate the panel, and we will be joined by Jihong, by Sujata, and also by Tanvir Shirolkar, also from Next Time India. Tanvir is responsible for the M&A vertical activities within Next Time in India. So I would like to start now with the first presentation, and we decided to break a little bit with the ladies first principle. I hope you understand that we decided to go east to west, starting in East Asia and China. So Jihong, the floor is yours, please.
Hi, everyone. Thanks for tuning in. My name is Yi Hong. I am in Singapore. Today, I'm asked to talk a little bit about COVID in the region China. So given the limited time we have for today, I will briefly cover some points where I can mention some elaboration. I'll do so. If not, I'll just touch and go. Next slide, please. So this is a slide that talks about the GDP growth of China between 2019 and up to second quarter of this year. So when COVID struck, that will be at quarter Q4 2019 and quarter 1 2020. Well, when COVID struck, the Chinese took the decision to go for a hard lockdown sometime in January 2020. China locked down its economy, and the lockdown has the effect of damaging its GDP growth. As you can see, in Q4 2019 to Q1 2020, the GDP growth was a negative of -6.8%. The lockdown in China was a rather short one. About 2 months or so, it lifted the controls and factories began to resume work. The economy start to rebuild and start to manufacture again. So from Q1 to Q2, we can see a rebound of GDP growth from a -6.8% to a positive 3.2%. And from then on, you can see that the GDP growth continued to grow over Q3, Q4 from 3.2, 4.9, 6.5, and in Q1 2021, it has reached an improvement of 18.3%. That's staggering and that's surprising. But after that, in Q1 2021, the growth started to drop. As we see in Q2 2021, the growth has come down to 7.9%. That is at the end of Q2 2021. Just 2 days or so back, China announced the GDP growth for Q3 2021, and the economy has been slowing down, pulling off, and the latest GDP growth was at 4.9%. The current circumstances are such that the economy is not doing robustly well, and it's continuing to slow down. And the forecast for Q4 this year is likely to be around 4.3%. Now, if you were to just take a look at the COVID effect on the economy, really the COVID impact on the Chinese economy is not very big. You can see the V-shaped recovery between Q4 and 2019 and Q2 2020. It went down quite big and it came up quite quickly in the next quarter. Now, as to why the growth started to reverse in trend, partly because of the new variant, Delta variant, that came on to hit China sometime in August this year. And that has put China back onto its warpath against the virus. And China adopting a COVID zero policy, it means a hard lockdown for cities or provinces where COVID is reported. So, and if that were to happen, and if Delta variant is not controlled, we don't really know at this point in time how the authorities are going to react to the spread of this Delta variant. Next slide, please. These are the points I mentioned just now. So the issue at hand now is that we do not know whether the Delta variant is going to cause major damage or major slowdown, further slowdown to the Chinese economy. This we only know as we go along and we see what's going to come out from China. Next slide, please. On this slide, I want to just cover a little bit about foreign direct investment in China. In the last few years, foreign direct investments have actually been generally moving out of China. The trend is such. This happened because I guess when the economy is going to mature, it starts to go up the value chain, and companies that low cost in production will find China becoming more expensive. And generally, the trend has been some lower value products, manufacturing start to leave China. But the thing is, over 2017 and from then on to now, the slowdown is also partly due to the trade war that we know about from 2017, 2018 onwards. And that had actually caused the exodus of foreign investments from China to speed up a bit. While the production costs in China's neighbors like Vietnam and India are cheaper, and the fact is that factories and plants are moving out of China, some of these, especially the lower value ones, going into the neighbors like Vietnam and India and Southeast Asia, like Malaysia, Thailand. While this is happening, COVID also has a role to play in this movement. In fact, quite on the contrary, what I was told on the ground is that COVID had in fact caused some of these investments that left China to do a U-turn and start to go back to China. The reason is they find China as a manufacturing base that is more of a one-stop shop, where it offers a full suite of manufacturing services at different stages of production. Some of the comments received is that factories that went to the neighbor find that the worker population there, the level of skills are not as good as in China. Likewise, for raw materials and parts and stuff like that, parts sometimes are not readily available. We're actually causing a disruption to a production process. So it is observed that during COVID, some of these foreign investments that left China are beginning to go back to China. Next slide, please. This is what I just talked about. And next slide, please. And this is the slide I want to share with you, which you can see. This is for the period January to June 2021 this year, where it says that the increase in number of investments in China has actually recorded positive growth. It has actually reversed in terms of outflow investment to additional investments into China. So the greatest increase was recorded in February this year, where the increase in foreign investment into China compared to the year before was 229%. And the other months are all record positive growth. So this is the trend that is observed happening in China. And this is, again, partly caused by COVID. And also given that China itself has its own benefits and attractiveness in bringing in factories, manufacturers into the into the country. Next slide, please. On this slide, I just want to share that the Chinese economy is going through a change, and some of this change may actually cause some disruption to the global supply chain. After all, China is known to be the world's factory, producing almost anything or everything from what you have at home to the heavy industries. So what happened recently, or this year, or late last, is that the authorities has been tightening the control over the economy. Climate change has caused the authorities to implement climate change measures. Some of these have inevitably caused disruption to its economic activity. What we have noticed in last few months is that there has been a surge in electricity, energy to power the factories. This is well seen when the China start to reboot its manufacturing plants, where all plants get back to production, and there was a sudden, or there is a huge surge in demand for energy, both for local factories as well as factories that cater to foreign needs. And because of the coal issue that now the world is facing, short of coal, and the price of coal has gone up, China is also facing a share of shortage of coal to generate power for its factories and home. So as China is going into its winter, demand for energy and electricity is expected to go up, as that is needed to warm heating plants and for home. So if the power crunch is not addressed, in China anytime soon, there may well be a disruption to the supply chain in the months to come. So this is something we are paying much attention, and really we have to see how this situation will play out. And this is something that I guess will tie in very well with today's topic on disruption to supply chain. And on that note, I think my time should be up, and that's all I have to share for now. Thank you very much. Raina, back to you.
Thank you, Yi Hong, for this interesting presentation. Do we have any questions from the audience? Yeah, there's one, Yi Hong, which is in the chat panel. Fairly long one, regarding the tendency to stay in China, but I suggest we address this question during the panel at the end, when we will be talking about some changes in the global supply chain structure. I would like to hand over now to Manika Bhatt from Next Time in India to start with his presentation.
Thank you, Rainer. Namaste. Greetings to everyone joining us today. It was good to hear my colleague from Singapore and get insights on impact of COVID-19 on the Chinese economy. I will say the situation in India is slightly different, and I will try to share brief insights on the Indian economy recovery through the pandemic and some TRI related facts which will be of interest to many of us here. Can you move to the next slide, please? Yeah. Numerous factors contribute to India's journey of becoming a favorable business destination. Despite the pandemic, the country has cushioned the impact from the waves of COVID infections. On your screen, key recovery indicators are displayed, which showcase India's economic recovery through the pandemic. In macro terms, the GDP of the country has shown recovery and growth, with various estimates expecting a 9.5% growth as compared to the dip of 7.3% in the last year. One of the key economic indices, which is the Purchasing Manager Index, which maps the demand of the Indian customers, has indicated that the country has done significantly better, with current PMI of greater than 50. As compared to last year in March 2020, the index has dipped to a low of 20-point mark. With the economic recovery and revival of businesses and people learning a new normal, we witnessed that the tax collections reached an average growth of 6% and a peak tax collection of $19 billion in April 2021. Similarly, on the FDI side, I think the situation has been quite different from the world. As the global FDI fell by over 40% in 2020, India saw a FDI rise of around 10% on year-to-year basis in the last year. These investments are primarily driven by investments in the three sectors, which were digital, services, and electronics. It is expected that India will be a key global destination in the future and will attract over $150 billion of investment by 2026. So in next 3-4 years per se. Government expenditure has been instrumental in the recovery of all the economies. So India was also not something different. The Indian government budgeted 13% higher expenditure for healthcare and infrastructure activities to aid revival of the businesses and decrease pressure on the industry. Further, such indicators demonstrate the recovery and strength of the Indian economy at an overall basis. Can you move to the next slide, please? In this slide, we'll try to share some key reforms which aided in India's recovery and also update on India's vaccination status, which I believe is a big question to the world due to the large Indian population. To start with the reforms, Atmanirbhar Bharat initiative or Self-Reliant India initiative is one of the flagship initiatives by the central government. The initiative aims to promote local manufacturing and develop robust value chain, which could make India self-sufficient in terms of domestic consumption. Several schemes were launched under this flagship initiative, including the one major scheme called production linked incentive, through which the government provided an outlay of $26 billion for 10 key sectors such as automobile, textile, energy, food processing, electronics, and several others. So it was one of the flagship initiative, and the government is putting emphasis on the local manufacturing in India through this. Next reform was towards boosting the business activity. In view of this, a massive $1.4 trillion was set aside to spend on upgrading the business infrastructure in the country, with the aim that this could further allow business ecosystem to thrive in the country. Government also eased certain regulations to provide support to the industry during the last year. To name few, they roll out the IBC, decriminalization of several provisions under the Companies Act. They are also looking at new unified labor code, just to name few of the regulations which the government is looking at easing. All this have contributed to improving ease of doing business ranking for India in the last few years. During the pandemic, developing connectivity and improving the communication system was of paramount importance. Telecom operators, electronic makers, and government stakeholders designed several blueprints to provide uninterrupted digital services, which could provide considerable ease to more than 1 million businesses in the country. The computer sector alone received an FDI of over $25 billion in the financial year 2021, which clearly highlights the growth and potential in India's digital sector. As the pandemic gripped India during the first wave, from a need assessment, the government identified that the healthcare infrastructure in the country was also in the need of an overhaul. So the union government assigned highest ever budget in the history of parliament to the healthcare sector, showing the country's faith in revamping existing healthcare systems. The country, through investments and several PPPs, ensured that the adequate kits, drugs, and testing facilities were available not only for domestic use, but also for international use. On vaccination front, the number you see on the screen are some 7-8 days old, but can still provide a good insights on the vaccination status in India. As you can see, India has fully vaccinated over 20% of its adult population, and over half the population has got at least one shot of the vaccine. Sorry. Ministry of Health has highlighted the India's strength in its robust vaccination plan, which is aspiring to vaccinate 100% of its working workforce by December 2021. So if the government is able to do well with their plans, we should have all the workforce vaccinated by December 2021. I think that's all for this slide. Let's move to the next slide, and I will provide a brief overview of the TRI landscape in India. One of the major developments in the last few years in the TRI space has been introduction of the Insolvency and Bankruptcy Code, which is generally called as IBC, as a sweeping reform which aim to revolutionize the insolvency ecosystem in India. As per the Economic Survey Report 2020, IBC has significantly improved and streamlined the resolution process in India. On your screen, you will be able to view the number of filings under the IBC. A total of over 4,000 corporate insolvency resolution processes have been initiated under the IBC till March 2021, and nearly 2,700 of them have been closed till date. During financial year 2021, there was a suspension on initiating IBC action in respect of default starting the date 25th March 2020, which was the date when the country actually went into a lockdown. The thought was to safeguard business interest during the pandemic period. The suspension of the code has been lifted and IBC filings are currently active, and we are seeing that the numbers are slightly starting to ramp up again. The framework's big success during the COVID phase was noted when insolvency issues involving the two large companies, namely Jet Airways and Videocon Industries, were reportedly resolved in June 2021 by the National Company Law Tribunal. Yeah. On the stressed asset side, in terms of NPAs, the Indian government has introduced a plethora of initiatives to combat this ever-playing issue of growing NPAs. While global NPA average is close to 6.2%, India's higher average is clearly visible, and we can see the steep rise in this also. Various reforms have been put in place to reduce the burden on banks. The introduction of backed bank concept has been welcomed, as the country is in need of a significant cleanup in terms of bank loans. While these reforms boost activity in the restructuring space, India continues to be an attractive destination for deals. Let's learn about this in the next slide. Next slide, please. Yeah. The COVID-19 pandemic caused significant uncertainty in 2020, which was further compounded by global trade tensions, regulatory pressures, and geopolitical issues. Despite these challenges, deal activity in 2020 outperformed the previous year. It was evident that the global investors' sentiment in India's ecosystem remains intact. Several large deals were concluded in the edtech, healthcare, and digital sector, with prominent players like Byju's, Paytm, Reliance, etc., in participating in those deals. Newer age companies are leveraging innovative technologies such as artificial intelligence, Internet of Things, big data, and deep consumer insights to disrupt targeted pockets in various industries such as fintech, e-commerce, education. Several startups have managed to accelerate through their natural growth cycle during the COVID era and have monetized their businesses. This has enabled the country to add 16 new unicorns from the start of the pandemic, which is a very high number during the pandemic year. It is also expected that India will further see significant investments and traction in financial services, electronics, renewable energy, as you can see on the sea, as the country aims to capitalize on the unique growth opportunities in the global market. I think let's move to the next slide. Yeah. A short case study to demonstrate our recent experience of supporting a client in TRI space during the COVID era. As part of the corporate carve-out transaction, a leading PE firm acquired certain logistic and product service assets of a leading global Irish company, which was engaged in business of electronic repair and services. It was a global deal, and a part of the deal also had the India business. As majority of the Indian operations were non-core to the PE firm and not profitable, the acquiring group decided to wind down the India unit. Nextdime was approached to support this winding down transition to enable a smooth downsizing of the operations prior to regulatory liquidation and ensuring full visibility to the global team during the wind down phase. A dedicated team was deployed on site during the initial phase to assess the existing situation, understand the company business operation and financial soundness, and thereafter build a roadmap as well as support and implementation of that roadmap during the operational wind down phase. The project was riddled with various challenges. To name few, they had an adverse cash position. They didn't had a operational transparency because the Indian operation director has resigned. There was ambiguity and they could not rely on the information they were getting from the Indian partners or the Indian employees they had. They had unsettled and unresolved disputes with tax authorities, with customers, with vendors. So it was a big mess which they wanted to clear, and they wanted to do it in a very quick pace, in a quick manner. They also had some 1,000+ employees operating in India at the time when the COVID struck and India went into a lockdown, and they wanted to actually ram those numbers down also in the COVID year. So these were a few of the challenges which we helped them mitigate. So in order to work on these challenges, we provided a comprehensive project management support on various critical components, which included forming receivables recovery strategy to successfully realize over 80% of the receivables, diligent employee ramp down plan in 9 months from 1,000 workforce to nearly 20, which was done in 9 months. We did the financial cleanup and book reconciliation in group accounts. We advised them on the FEMA compliances. There were huge penalties which could have popped up because of the intercompany receivables which were long outstanding, and India has certain regulatory framework to ensure that those are handled smoothly, and I will say many more. In terms of sheer impact, our team's overall project support provided the much needed transparency, unbiased and thorough view of the business position, and on-ground implementation support of the ramp down of our operations, especially during the COVID era, which was thoroughly appreciated by the global team. Thank you. I think this is all for today. Happy to take questions if any.
Well, thank you so much, Manik. I don't know if we have a question from the audience. I don't see any here in the chat. If you allow me, Manik, I have one question towards the case study. What was the reason for the company to decide about the winding down of the activities? What drove it? I understood it was not COVID. COVID just came after they made the decision. Is that correct?
Yes. So Rainer, it was a non-core business for them. The Indian business was acquired. Also, the business was quite established. They had some 1,000+ employees in India and offices in some 40 cities in India. But they thought that it's a non-core business for them, and it got acquired as part of a global deal. And that's the reason they wanted to wind down the India operations. Okay,
understood. Thank you. Well, it really a great presentation and impressive numbers with the number of people already vaccinated, and then the goal to have the workforce fully vaccinated with 2 shots by December this year. So I wish you and all your countrymen success in that, and we'll keep our fingers crossed. Without India, I don't know how many, if you have a number, how many vaccine doses India produced and exported, but from what I have been perceiving here in Latin America, without the production capacity of India in the pharmaceutical and especially the vaccine sector, we all would be in a much worse place than we actually are. So thank you for that.
I think we are all in this fight together too. Yeah.
So let's go from India across the Indian Ocean to a little bit towards the southwest, and hear what Sujata can tell us about COVID and the impact in Tanzania, Kenya, and the East African region. So please, Sujata.
So hello, everyone, and Jambo Sana, everyone. For those of you who have never met me, my name is Sujata Jaffer. I'm the managing partner of Nexia SG Tanzania and Kenya. Our companies in both the countries, it's a full service firm. So we offer all audit, assurance, advisory, tax and consulting services. And I'm very pleased to be given this opportunity to talk about the impact of COVID-19 in Africa and the future growth prospects. So thank you so much for this opportunity. Maybe we can move to the next slide. Okay, so just a quick introduction on the impact of COVID-19 in the African continent. Basically, it has impacted greatly. As you can see, continent has entered its first recession in half a century, and the GDP is contracted by 2.1%, which is quite high. As we all know that Africa is an emerging market, and already, the impact of COVID has actually regressed it a little bit. So we are hoping that, the future outlook will help Africa to emerge and grow. The regions that were affected worst, well, obviously South Africa was the hardest hit by the pandemic, and the economic contraction was 7%. West Africa was estimated to have contracted by 1.5% in 2020. Of course, East Africa is the most resilient region thanks to its less reliance on primary commodities and greater diversification. And the top performers in 2021 look like Djibouti is going to grow by 9.9%, Kenya 5%, followed by Tanzania 4.1%, and Rwanda 3.9%. The most affected sectors in the African region, and particularly in the East African and the Sub-Saharan regions, were tourism, health, transport, including storage, remittances, obviously the trade, agriculture, public financing, and government budgeting. These were definitely affected worst because of lockdowns. In our neighboring countries like Kenya, Uganda have had many lockdowns, and obviously lockdowns globally. So, there were no trade happening between Africa and other parts of the world. It was really restricted and very much limited. And obviously the bottlenecks caused by, the testing, the lack of vaccination, the uncertainty, and all of this has really impacted the African region and the cross-border business that went around. Particularly the tourism sector was the worst hit. And we're hoping that, the vaccination and the opening up of the rest of the world will actually help us in our future growth. Next slide, please. So the Africa's future growth prospects depend much on obviously the effective deployment of vaccines. It's very critical. The last statistics I had was that less than 2% have been vaccinated in Africa, because we all know that there was shortage initially when the vaccines were produced, and Africa was the last to receive them. Fortunately for us now, we have vaccination in the East African region, and we are hoping that by mid next year, at least majority of the East African states will be vaccinated, at least the adult population. The recovery trends obviously will be driven by resumption of tourism, like I had mentioned earlier, because we are very much dependent on tourism, which in turn affects the hospitality sector significantly, and all the businesses surrounding the tourism, the tour operators and all, they were the worst hit. So we are expecting that the opening up of the rest of the world, and particularly recently, Tanzania is now off the red list. So that will bring in tourism. Obviously, the rising commodity prices and the rollback of pandemic-related restrictions will help us in 2022 and onwards. The most exciting moment for Africa for post-COVID recovery is the African Continental Free Trade Agreement. The agreement offers opportunities for collaborative action, allowing Africans to do business with each other and strengthening Africa's resilience. So up to now, the African continent did not trade much with each other. And we are hoping that this agreement, which was signed in February 2021 by the 54 member states of the African Union, will open up the trade and cross-border business, particularly, obviously, the tariff concessions that are, offered, and the free movement of labor and transfer of knowledge and technology will open up the trade for the African continent, and it will even bring about opportunities for trade with other parts of the world, particularly Europe. The most critical and enabling factor for the AfTA will be the infrastructure. So this infrastructure will improve connections between and within countries, so goods and services can access market. This will create liberalized market for goods and services, will enable movement of capital, will facilitate investment through creation of large markets and new technology, and it will boost productivity. And this eventually the elimination of tariffs on intra-African trade will facilitate trade and growth in the market. Next slide, please. So just talking briefly about the outlook and risks in Tanzania and Zanzibar to begin with, and then I'll talk about Kenya and Uganda and other regions. So the economic outlook looks positive. We are expecting a GDP growth of 4.1% in 2021 and 5.8% in 2022 due to improved performance of the tourism sector and the reopening of trade corridors. Energy and fuel price increases are expected to persist in 2021, raising overall inflation to 3.9% in 21 and 3.4% in 22. Spending on large infrastructure projects, obviously, and the depressed revenue performance are expected to widen the fiscal deficit. And the major downside risk to the outlook includes business regulatory bottlenecks that constrain private sector activity and uncertainties regarding the pandemic. Next slide, please. So these are the sectors in which there are opportunities, both in Tanzania and Zanzibar. I'll just quickly take them through because of lack of time. So it's mining and gas, oil exploration, road construction, tourism and hospitality, and telecom. Same goes for Zanzibar and Pemba. There are a lot of opportunities that have opened up investment in the following sectors, particularly now like Zanzibar and Pemba are offering small islands which are available on long leases. Fisheries is being promoted, and Zanzibar has introduced Zanzibar Investment Promotion Authority to facilitate private sector investment. Next slide, please. So Kenya was greatly affected by COVID due to lockdowns. The expected growth in 2020 is 1.4, obviously that's past now. And the country relies on local demand, which was also subdued. The government has borrowed heavily and the public debt has really gone up. The overall outlook still looks good, particularly in 2021 and 2022. Uganda has been the most affected by the COVID-19 pandemic due to several lockdowns, tourism and hospitality has been severely affected, and government had to borrow as revenue collections had gone down. Overall outlook looks challenging. Next slide, please. Thank you. And if you have any questions, I'll be happy to take them. Thank you very much.
Thank you so much, Sujata. Let's see if we have questions here from the audience. Anyone with a question for Sujata? It appears no. Thank you so much, Sujata. What I really find interesting, and which for probably most people in at least the Northern Hemisphere went unnoticed, or at least in the business community, is the creation of this huge free trade zone, which I think is great news. Do you know if there are already any negotiations between that free trade zone in the African Union and the European Union, or maybe the North American free trade zones underway?
So the African Union, obviously, the fact that all the 54 African states have signed the agreement, which is a very positive move, because as we know that even pre-COVID, US and China was at trade war, and that had already weakened the supply chain. And then the COVID-19 impacted further. So I think everybody was looking at sort of redirecting and reviewing the supply chain. And so the creation of this African free trade, African continental free trade agreement in African states will sort of focusing on promoting trade and looking at how the supply chain can be managed within the African continent, and of course even looking at Europe, because many of the African countries are exporting to Europe and are importing from Europe and other parts of the world. As you know, China was one of the second largest trade partner for Africa, and particularly Tanzania. And due to the COVID-19 impact and the supply chain disruption, now Africa is relooking at forging a partnership with Europe, and we are hoping that this trade agreement will sort of help in forging the partnership between Africa and Europe, which particularly Europe, where they're looking at labor-intensive sectors. I think Africa would prove to be a good investment, as you know, it will enable low-cost skilled labor, and also it will help in economic development of Africa. And that means the wealthier Africa, meaning a larger market for Europe for trade. So that is kind of a positive move. Yeah.
Okay, well, thank you. I'm sure we will hear more about this African free trade zone over the next couple of years. And it will be really interesting to see how Africa will position itself between the various already existing trade blocks. I would now like to welcome Tanvir Shirokar for the panel, as well as Yihong Chan. We have a couple of questions. We have like, I think 20 minutes left for the panel discussion. With a couple of questions, and if someone from the audience would like to add a question or two, feel free to put them in the chat box. So we will talk about that as well. Next slide, please. Good. The first question that I have, I would like to direct to Yihong and the Asian region, because in the presentation from India, we learned that by December, the workforce will be fully vaccinated, and Sujata had the 2% current level and a forecast for maybe mid next year. Yihong, according to a recent publication from Bloomberg, about 70% of the total population in China seems to have been fully vaccinated twice, so that's already a high number. But how is the situation in Southeast Asia? Countries like Vietnam, Thailand, the Philippines. Can you give us any insight on where they are on the vaccination spectrum?
Okay. Now, I don't have exact details, but what I remember is that Thailand is increasing its vaccination rate. I think they are not 50% yet, right? And for Malaysia, it's quite advanced. It's almost 80% also. Singapore is 84% of the population has been vaccinated, right? And generally at different degrees, but I would say that countries are ramping up the vaccination rate. So I can make a guess that maybe by end of the year, most countries should at least more than 50% vaccination rate for Southeast Asia countries.
Okay, thank you. Then let's maybe move to the second question. We have seen, obviously, in the various regions and markets, mounting debt on the government side for the public sector, giving loan programs or social assistance to the population, paying for vaccines. But we have also seen raising debt on the company levels, getting through the COVID pandemic and making sure there is enough cash in the accounts. Obviously, that has led to, in certain cases, an increase in non-performing loans and assets, which will have to be worked out. Just going back to the presentation we saw from India, I think one number there, if I saw that correctly, was an amount of about 100 billion in debt, bad debt, basically, which has to be worked out over the next couple of months and quarters. So how has this trend and the situation shaped up recently for distressed assets, and maybe where you can elaborate on the situation and also the opportunities maybe for distressed investments in India, please.
Yeah, hi. So traditionally, for lenders in India, the recovery was collateral based. Okay, so you go and lock the factories, and then there is a process to recover those assets. But with the advent of insolvency and bankruptcy code, which we call IBC, the creditors could now tap the enterprise value of the company. Okay, so this code provides for a time-bound resolution with a predefined waterfall for different types of creditors. In fact, IBC has helped to improve the recovery rate from 26%, as we could see in the earlier regime, to 43%. And the recovery time has also reduced from 4 to 6 years to 1 to 2 years. So this has a huge positive implication for distressed debt investors. Just to give an example, SR Steel was in a debt, and the debt was around $7 billion, and the liquidation value was around $2.5 billion. But with IBC process, there was a sale to strategic investors, and that could garner around $6 billion for the creditors. So you see, the IBC has played a major role in unclogging banks' balance sheets, and and pushing it for reallocation of capital for more efficient use. So as the IBC is evolving, we see that the acquisitions of distressed assets is increasing, and because the investors are getting more valuable and high quality assets at a discounted value. Just to give an example, in mid 2017, there were 12 large accounts which went under IBC process, and 9 qualified for lucrative mergers and acquisitions and fetched a worthwhile recoveries from the bank's perspective. Okay, so we also see recently investments from few international players, private equity and pension funds, who have shown interest in investing in distressed assets. So the distressed asset situation was not just on account of COVID. In fact, it was before COVID also, but COVID increased this stress. But at the same time, there were policy and regulatory measures from the government to revive the negative effects and preserve the financial stability, like increasing the moratorium on debt repayments, policies in regards to asset class reclassification norms, and then expanding liquidity in the system to resolve the normalcy. I just also want to highlight some challenges faced in M&A of distressed assets and what are the opportunities for the investors. So basically, there are valuation challenges, valuation of assets that needs to be adequately insulated from the promoters and the owners, because normally they use proxies to derail the bidding process or jack up the valuations. The speed is very critical. At the same time, you need to retain the employees. You need a proper plan to how to make the company profits or turn around the company in future. And you also need to assess the reputational damage which has been caused with key vendors and customers. In terms of opportunities, acquiring these distressed assets would give the companies acquisitions of employees or talent or business processes, expanding customer base, and of course you get a value at a very discounted price. So yes, the stage is set for investors with patient capital looking to invest in Indian stress assets space, as the regulatory framework has evolved and the risk return profile is quite attractive.
Yeah. Okay. Thank you so much, Tanvir. It's interesting to hear that the recovery rate has risen substantially on the outstanding debt. That's really impressive. Sujata, can you maybe in a minute or two briefly talk a little bit about anything you have seen in distressed asset investments in East Africa? Is there a lot of activity, or is that still building up?
Okay, so in Tanzania in particular, the distressed assets have definitely increased due to COVID-19 impact. But so similar to the situation in India, it is offering good assets at a very good quality assets at a very reasonable price as opposed to in the past. But the investment in these assets at the moment is very, very slow because like I mentioned that Africa, and particularly East Africa, has been impacted a lot. So people are kind of holding on and they're not investing that much. But obviously, the financial institutions, the banks and all have been affected badly, and the bad debts have increased. So that has caused financial strain. Unfortunately, there has been no support from the government. So the situation is still like, critical. But we are hoping that, the opening up of the market and the change in policy and, government is trying to put in place incentives for attracting foreign investments and creating an enabling environment, and that will help in reviving the sectors. But obviously there has been quite a lot of insolvencies due to that, and particularly the tourism sector, the hospitality sector has been affected a lot. But this has also encouraged mergers and acquisitions, and thereby creating opportunities for us in the form of carrying out due diligence, particularly at the time of mergers and acquisitions. And obviously, that has created opportunities for us in as consultants, to provide that support.
Okay,
yeah.
Thank you. Besides the distressed asset investment, how do you both, let's talk a little bit more about India and then East Africa. What about other investment areas and trends that you see once, let's say, COVID is behind us, in like whenever it will be in the region, maybe 2022, 23, 24? Where do you see the focus of foreign direct investment going?
Yeah.
So, Tanvir, please.
Yeah. In terms of India, the emerging trends, in fact, the companies after post-COVID are working towards making their supply chain more resilient, and even the production systems. Because of travel restrictions and social distancing norms, we see, advanced technologies are being used to serve the people. So in terms of opportunities for investments, sector-wise, first is healthcare, technology, and infrastructure. Because this sector needs upgradation at every level, right from infrastructure development to delivery to process management. And there is already a green signal by the government to telemedicine and doorstep drug delivery, so which has thrown a lot of opportunities for investment in this sector. There is use of artificial intelligence, robotics, right? So all these things are making this sector very attractive. Second was automotive, and there is a transition from to hybrid or electric vehicles. So that is the area where we see a lot of investments and collaborations. India is also becoming a hotspot for offshoring of automotive design and engineering services, and being seen as a favored sourcing destinations for automotive components for various international companies. The third is retail. In fact, retail is one sector which is affected both positive and negative ways. The longer the COVID, I think the greater the chance to to move to online and omni-channel purchasing, and there we are seeing a lot of deals happening. Electronics, basically India depends a lot on China for batteries and e-vehicles, but government is also pushing for local manufacturing, and there are incentives being offered. So there is immense potential for manufacturing of such products for captive consumption also, and for a base for exports also. Then there is education, technology, and vocational training, where we see a lot of deals. Insurance is one sector, because large population of India is without any insurance. And the crisis of this scale has increased the need to obtain insurance.
Sure,
so we see significant uptick, in this sector also.
Tanvir, excuse me that I interrupt, but I'm getting here a signal that we have only 4 minutes left.
Absolutely.
And I would like to the next two questions combine into one. There's a lot of publication and talk about the supply chain disruptions. There are empty shelves in some supermarkets and hyperstores in the US and sometimes even in Europe. Due to COVID, there has been a halt in some car manufacturing plants in Europe, North America, and even here in Brazil, because of missing semiconductor and electronic elements and chips. What I found, and Gihong, maybe that is a question for your region. What I really found interesting is the trend that before COVID, some foreign direct investment left China, went to maybe Vietnam, Thailand, or other countries in the region. And that trend then really turned around during COVID. So you have more companies opening in China with foreign direct investments. My question here is, how do you see that over like the next 3-4 years? Was this just a short reaction due to COVID? Or do you think that will be continuing? And then the second, and you talked a little bit about this in your presentation about the energy mix and the problems that might appear here. I don't want to force you to give a weather forecast for Beijing in February next year, but maybe you can elaborate of some of the things that we talked before, which for most of us are not really on our daily radar screen. Please, yeah.
Okay. So maybe I take your second question first, which is on the energy part of things, right? China has embarked on the climate change measures to bring down the carbon emission. So it has set ambitious target to become carbon neutral by 2060. That target may have to shift because, as we can see from COVID, the caused major supply disruptions and people are now looking at how to ramp up or how to get back to their production level. So the obvious solution is, look, if I had been doing well in China, China being a reliable manufacturer, and in order to meet my demand from my customers, the obvious answer is to get back to your manufacturing plants in China. So, and therefore, plants are moving back to China. So in terms of the weather and the energy thing, because February next year, it's going to be the Winter Olympics. So China is going to hold the Winter Olympics. Obviously, it wants to project a clear sky and a good host. And the last thing you want to see is fog all over the place. So, and because it is China, I mean, the government says do something, everybody will do. And what I observe is that, like what I observed in 2008, the Beijing Olympics, the authorities practically flushed the streets, water jet the streets, and shut all the factories that produce a lot of carbon and stuff like that, just to make sure that the sky is clear. So what I heard is that will kind of support the government policy now to try and bring down the burning of coal and stuff like that. But again, it runs against this supply chain disruption objective. So government, I read and I was told that just very recently, the authorities have reversed again its policy to ask the coal to continue to produce more coal and companies to burn more coal so that more energy is produced and so that factories can work. So the authority is trying to make sure that all this shortage in supply will be met from now. And in terms of the change in the supply chain structure, I can't really tell beyond 5 years, but I think for the next 2-3 years at least, and assuming COVID is still with us, any prudent producer or manufacturer would want to be a reliable supplier of goods. So the obvious solution might well be to continue production in China. So that would be my view, maybe at least for the next 2-3 years.
Okay, thank you so much, Yihong, for your view on this. I certainly agree that COVID will still be with us for longer than we all want. And so 2-3 years is probably a very realistic time frame until it's really, I don't want to say disappearing. It will go from a pandemic to a more endemic virus, but just looking at vaccination progress in Africa, that still has to get to a level where Asia and Europe are, booster shots, then we're very quickly in the year 2023. And probably supply chain disruptions will be with us for a couple of quarters or maybe two years until everything will sort itself out. I want to, given that we are 2 minutes before the end of our planned time, see if we have any questions from the audience for the panelists. Anyone with a question? No, apparently not. Then I would like to thank very much Sujata, Tanvir, Yihong, and Manik for their presentations and the participation in the panel. Thank you all for attending. There is a feedback link here in the chat box, so if you would like to give us feedback, we would very much appreciate this. The recording of this webinar will be available on Nexia's website in we will let you know by email once we upload both the recording and then also the presentations to the website. Thank you so much, and you all have a good day or a good night, depending on where you are. Bye-bye.